We have supercomputers resting quietly in our pockets, real-time data beaming down from satellites in low Earth orbit, and artificial intelligence scraping global news before the events even finish happening. You can trade from a beach, a bathroom, or a moving train, armed with more processing power than the entire space program used to land humans on the moon. Yet 90% of retail traders still lose money. Now look back to the year 1915. A man sits in a quiet, slightly dusty office. He is wearing a heavy wool suit. He has a pencil, a ledger, and a telegraph machine that clicks maybe twice an hour. He does not know what a relative strength index is. He has no idea what the price of gold is doing this exact second, and he wouldn't care if he did. And that man would completely and utterly destroy you in today's markets. His primitive lack of technology wasn't a disadvantage. It was the ultimate psychological cheat code. Today, the platforms you use are beautifully designed, colorful, frictionless pieces of software built by the exact same behavioral psychologists who design casino slot machines. You are not losing because you are stupid. You are losing because you are acting completely rationally inside a system mathematically engineered to harvest your central nervous system. The early pioneers of speculation succeeded because their environment was violently difficult. It filtered out the weak, it enforced absolute survival, and it rewarded extreme, unshakable conviction. We think faster execution equals better trading. Your modern broker gives you an app where you can enter a massive financial position with a gentle tap of your thumb while you are waiting in line to order a coffee. It feels like freedom, like true financial empowerment. It is actually a trap. This total lack of friction removes the only barrier standing between your fragile human emotions and absolute financial ruin. When you take a loss, your brain instantly floods with stress chemicals, screaming at you to fight back, to revenge trade, to win it back right now. And because the button is right there, glowing softly on your screen, you press it. Early traders had to physically stand up, put on a coat, walk down the street to a brokerage office, or at the very least, pick up a telephone and wait for an operator to connect them to a human being. The sheer physical annoyance of placing a trade gave their highly agitated brains 20 minutes to cool down, process the fear, and realize their new idea was a very confident mistake. The friction saved them. Is the one-click buy button the most expensive and destructive feature your broker ever gave you? Then we have the quiet, devastating reality of leverage. Your modern broker hands you 100 times leverage, or sometimes 500 times leverage with a warm smile. They tell you it is a tool to level the playing field, a way for the little guy with a tiny account to finally make big money and escape the rat race. They are lying to you. Brokers do not give you massive leverage to help you grow. They give it to you because extreme leverage chemically mimics a slot machine in your brain. It ensures that your inevitable human mistakes are fatal. It guarantees that eventually, you will self-destruct and return all your capital back into the market ecosystem. Pioneers traded primarily with actual cash or very modest margin. If the market dropped 2%, they were mildly annoyed. It was a bad Tuesday. For you, a 2% drop is an account-destroying margin call that ruins your entire month. They survived because survival was the default setting. If your broker permanently capped your leverage at 1-to-1 tomorrow, would you actually learn how to read the market, or would you quietly quit because the lottery ticket thrill was finally gone? When I worked as a prop firm data analyst, I spent my days quietly staring at the back-end servers. I analyzed the raw data of thousands of funded traders to find the exact cold mathematical difference between the 1% who extract huge payouts and the 99% who blow their accounts and disappear. I took that classified data and put it into a book. It gives you the exact unfiltered metrics of the top 4,000 traders, their frequency, win rates, risk to reward, and daily loss limits. More importantly, it gives you brutal, mechanical rules to physically force patience and stop your own self-destruction dead in its tracks. It is a step-by-step survival guide for a rigged game. It is time to mechanize your mind. Grab the book through the link in the description right now. Consider how we look at prices today. You sit for 8 hours staring at auto-generated, perfectly smooth digital charts. The computer does all the work. You just sit back and watch the colors flash. Traders like Jesse Livermore recorded every single price movement by hand. They sat with heavy paper ledgers and drew the charts themselves, marking down the numbers as they arrived on the ticker tape. The physical act of writing down the price forced a visceral, slow-paced understanding of how the market actually moved. They felt the momentum in their wrists. Technology automated this process and completely severed our physical connection to price action. We stopped feeling the market and started just watching a video game. If your beautiful trading platform broke down and you had to physically draw your charts with a wooden pencil for a month, how many of your current trading setups would you suddenly realize are absolute garbage? We also pay thousands of dollars a year for millisecond-level data feeds. We are convinced that knowing the price right now, this exact fraction of a second, gives us a massive competitive edge. It actually just destroys your nervous system. Watching a 1-minute chart gives you the heart rate of a hummingbird on espresso. You react to every tiny twitch. Early traders waited for the morning newspaper. Because they literally could not react to intraday fluctuations, they were entirely protected from the noise. They were forced, against their will, to only trade the macro trend. Does knowing the price every single second actually make you a worse decision maker? And look at the modern trading screen. It is covered in lines, clouds, moving averages, relative strength indexes, and oscillators. It looks like a complicated laser light show in a cheap nightclub. We rely on these indicators because we secretly believe they can predict the future. In the early 1900s, none of this existed. There was only raw price, pure volume, and human psychology. Early speculators faced the market naked. They didn't have colorful mathematical lines to blame when things went wrong. Are technical indicators just psychological pacifiers for traders who are too terrified to face raw uncertainty? Then there is the quiet poison of other people. Today, you exit trades entirely too early because you got scared. You enter trades far too late because you felt the crushing weight of missing out. You think these are your emotions, but they are not. Your bias is constantly being violently swayed by the thousands of screaming voices on social media. Early speculators operated in an absolute information vacuum. They sat in quiet rooms. There were no online forums to infect their minds with panic or greed. They had to trust their own thesis because there was no one around to tell them they were wrong. How much of your daily trading anxiety is actually yours, and how much have you unknowingly absorbed from highly leveraged strangers on the internet? Because of how fast and cheap modern trading is, scalping has become the default strategy for retail traders. We jump in and out of the market 30 times a day, suffering death by 1,000 tiny paper cuts. Because transaction costs were massive, and execution was agonizingly slow a century ago, scalping was physically impossible. Every single entry required a heavy capital commitment. You could not afford to be wrong and just jump back in. You had to be dead right about the major direction, enter the market, and hold on for dear life while the trend played out. Commitment was simply mandatory. If your broker automatically locked you out of your account for 7 full days after every single entry, would your overall win rate suddenly skyrocket? We obsess over candlestick patterns today. We see a red candle with a long wick, and we calmly call it a rejection block. It is just a shape on a screen. It feels clean. It feels safe. In the physical trading pits of the past, pioneers did not look at screens. They looked directly into the sweaty, terrified faces of other men. They listened to the pitch of the screaming voices shift from greed to absolute panic. They read human emotion in real time. They understood that the market is just a giant, terrified animal. Have beautiful, perfectly colored candlestick charts made us completely blind to the actual human suffering and greed that drives every single price movement? Today, you are probably getting stopped out by random, violent intraday wicks on the 5-minute chart. The short-term charts are designed by heavy algorithms specifically to hunt for your liquidity and trigger your stop losses. Early traders largely ignored the entire day. Many only cared about the final daily closing price, or even the weekly close. Whatever madness happened at noon was entirely irrelevant to them. They dismissed intraday volatility as pure, meaningless noise. If you were only allowed to see the daily closing price and never saw the intraday wicks ever again, would you still be losing money? Perhaps the hardest thing to do in modern trading is absolutely nothing. We feel that if we are sitting at our desks, we must be clicking buttons. We must be in a trade to call ourselves traders. Without a glowing screen blasting flashing colors into their retinas, early traders learned how to exist in silence. They spent days, weeks, or sometimes entire months doing absolutely nothing, just waiting for the perfect, undeniable alignment of price and macroeconomic conditions. Boredom was highly profitable. Are you actively losing money simply because you never learned how to sit quietly on your hands and be bored? We love to celebrate the democratization of finance. Trading used to be an exclusive, highly restrictive profession. It required significant capital, deep industry connections, and an immense amount of time. Now, anyone can start trading with $50 on a mobile app while riding the bus. It sounds beautiful, fair, and revolutionary. But when the barrier to entry drops to zero, it simply brings millions of uneducated, highly emotional participants into a deeply hostile arena. Has the beautiful democratization of trading secretly just turned the working masses into easy, endless liquidity for massive financial institutions? You probably keep switching your trading strategies every few months. You abandon moving averages for order blocks, and order blocks for volume profiles, constantly searching because the last strategy stopped working. You treat the market like it is a math puzzle that can be solved if you just find the right formula. Early traders knew it couldn't be solved. Without global 24-hour news feeds, they accepted that the market was largely unknowable and deeply unpredictable. Because they could not predict, they were forced to manage risk. They survived because they prepared to be wrong, rather than trying to be perfect. Is your endless obsession with finding the perfect trading strategy just a subconscious refusal to accept that trading is ultimately about losing gracefully? Finally, we have to talk about how the money feels. A digital loss on a modern screen does not physically hurt the same way losing physical cash does. Modern trading platforms use bright colors, pleasant notification sounds, and smooth animations. Early traders dealt with the actual physical delivery of paper shares or commodities. When they lost, it felt intensely real and violently heavy. Today, we are entirely disconnected from the gravity of our own capital. Has the clever gamification of modern trading platforms successfully tricked your brain into treating your hard-earned life savings like disposable video game tokens? When we look at the modern trading landscape, we just see chaos. We see blown accounts, burnt-out retail traders, and a graveyard of useless indicators. But when we look at the quiet pioneers of the past, a very clear psychological pattern emerges from the dust. Leverage is a psychological weapon heavily disguised as a generous gift. Your broker wants you to feel powerful, precisely so you will hang yourself with that power. Technology heavily optimizes your execution, but it completely ruins your psychology. We built faster computers to get better entries, but accidentally created an ecosystem that perfectly exploits our biological fight-or-flight response. The faster the technology moves, the worse our emotional reaction becomes. Ignorance was a literal shield. By not having access to a constant feed of global panic, early traders were protected from narrative whiplash. They had to trust the long-term trend because they didn't have a device in their pocket constantly demanding they doubt it. We view high friction as a terrible negative. We hate slow execution, high fees, and waiting for data. But historically, high friction is the holy grail of risk management. Friction is the only force in the universe strong enough to stop the human brain from overtrading in moments of blinding panic. We have completely redefined what having an edge actually means. 100 years ago, having an edge meant possessing immense emotional resilience, patience, and strict discipline. Today, a new trader thinks an edge is just a $50 custom software script they bought from a teenager on the internet. We are desperately looking for solutions in software that can only ever be found inside our own psyche. You are not broken. You are not inherently bad at this. You are just a very normal human being, sitting inside a digital casino that has spent billions of dollars figuring out exactly how to make you click the wrong button at the worst possible time. If you want to survive the modern market, you have to stop chasing faster data. You have to stop adding more glowing lines to your chart. You have to do something much harder and much stranger. You have to artificially recreate the friction of the past. Delete the app from your phone. Force yourself to walk to a computer to trade. Cut your leverage down to the point where a loss feels boring rather than terrifying. Stare at the daily chart until the intraday noise stops making you sweat. The greatest traders who ever lived didn't win because they had better information. They won because the world they lived in forced them to act like professionals. Since your modern world will not force you to do that, you are just going to have to do it yourself.